Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today we're going to take a look at two brand new covered call ETFs that have come out. Well, one of them is not out yet, but maybe by the time this video comes out, it will be. That have hit the Canadian stock market. So these two funds are going to be listed on the Canadian stock market, just in case my American friends are watching and will have trouble finding the stock symbol. It's because these are Canadian listed funds. So the first one is going to be from Evolve ETFs. And the stock symbol is UTES, the Evolve Canadian Utilities Enhanced Yield Index Fund. I got excited when I saw enhanced in there because this is Evolve's second leveraged covered call ETF, right? So bank is going to be their first one, and this is their second one that's actually leveraged. The other ones, their other covered call ETFs are not leveraged. So pretty exciting. So it's actually very, very similar to bank. It's 10 stocks, just like bank. We're going to take a look at them in a second. It's got the same management fee as bank at 60 basis points here. And, you know, they're all Canadian stocks as well. They follow an index just like bank. This is going to be the Selective Canada Utility Index ETF. So as well, the covered call strategy is the same. It's up to 33%. You see that here. 25% leverage and applied covered call strategy applied on up to 33% of the portfolio. So very, very similar style structure as their other leveraged covered call ETF, except the stocks are different. This is going to be 10 Canadian financials. This is going to be 10 Canadian utility stocks. So in terms of the stocks, you have utilities at 40%, you have telecom at 30%, and pipelines at 30%. All sectors that could really fall under the utilities umbrella. So here are the stocks. In terms of utilities, you have really four big electricity generators, utility companies in Canada. Hydro One, AltaGas, Emera, and Fortis. Of course, we all know about these companies. The top three, telecom, there's only three of them in Canada: Bell, Telus, and Rogers. And the pipelines, it's the biggest three. You got Enbridge, which is the biggest one, TC Energy, and Pembina Pipeline Corp. So very interesting here. If you want utilities, this is actually, I commend Evolve for having fantastic timing. We know that interest rates going down, which has been happening in Canada, typically props up not only dividend stocks in general, which these are all dividend stocks, by the way, but the utility sector in particular. So definitely interesting. This ETF just came out. So of course the AUM is very small because it just came out. Volume will probably be low on it, guys. No need to panic on that. Remember that it's brand new, and I'm sure that volume and AUM will pick up with time. I do think that this is going to be a very successful ETF. So definitely interesting if you want more defensive nature, defensive concentrated portfolio, pretty diversified in the utilities space. It with the breakdown that you see here, right? Utilities, electricity generators, also telecom, also some pipelines. So I really like this ETF. I'm not sure if I will invest in it or not, but yeah, super interesting. You see here that they're writing, you know, you actually see the covered calls on the individual stocks. This is something I love that Evolve does. They actually show all the options. So you see the strike prices here, for example, on TC Energy, call at $64, the expiry date. So pretty interesting ETF. I love the fact that it has 25% leverage. You guys know I'm a big fan of adding a little bit of leverage. This, you know, obviously increases the risk and volatility a little bit, but because the sector is fairly defensive, I think it's completely fine in terms of, you know, risk. It doesn't increase it too much, but very interesting if you're, you know, you want to get into Canadian utility space. You don't mind a little bit of leverage. So this one, again, same structure, same type of style as bank. I also really like the fact, by the way, that it has a low management fee of 60 basis points, which your typical covered call ETF management fees typically 65 to 75 basis points, something like that. So this does remind me a little bit of the ENCL Global X ETF, which is the Global X Enhanced. So also 25% leverage, Canadian oil and gas. So the difference is that this is really energy, and this focuses on utility. So if we look at the 10 stocks, or I think there's 11 stocks now in ENCL, we can't look at ENCL because it'll just show us this here, but we got to look at ENCC, the non-leveraged version, to look at the stock. So you're going to have some overlap. You're going to have basically 3 of the same stocks that are in ENCL or ENCC in UTES. So that would be the pipelines, right? Because the pipelines could be considered not only energy stocks, but utility stocks. So the 3 companies that are overlapping is TC Energy, Enbridge, and Pembina Pipeline. That's the only overlap. ENCL, ENCC, the other companies are, there's another pipeline, Keyera, but the rest, they're all oil and gas producers like Suncor, Canadian Natural, Imperial Tourmaline, etc., etc., etc. So it could be a good, I would definitely say UTES is going to be a lower risk ETF than ENCL. Not that much lower, but definitely lower because utilities are, less risk than oil producers, oil and gas producers. But it could be a great complement if you like the sector, you want to add a little bit more defensive nature, and you like Canada, you want to invest in Canadian stocks, big cap, blue chip, dividend paying Canadian stocks, all of these stocks, ENCC, ENCL, as well as UTES, they're all very popular dividend stocks as well. So it could be a good complement to ENCL for sure. There's other utility style covered call ETFs. There's UMAX, which has a lot of the same companies. There's ZWU, but ZWU, there's US and Canada. There's also HUTE, HUTL from Harvest, but this is global utility. So I think that the one it matches the most in terms of stocks is going to be UMAX, because UMAX is also just Canadian stocks, but UMAX is not leveraged. And UTES is, so that's a key difference as well. So in terms of yield, well, UMAX does cover at the money covered calls on 50% of the portfolio, which is fairly aggressive. You got to give up, basically you're giving up 50% upside. But Evolve is up to 33%, and Evolve typically does slightly out of the money calls. So in terms of yield, if UMAX gives about 13, I think Evolve is gonna, this one here is gonna be about the same yield. Because of that leverage, right? So they're doing less covered calls, but there's that 25% leverage. So my estimate, the yield is probably going to be between 12 and 14%, something like that. Maybe lower, I'm not sure. We'll have to see with the first distribution, but Evolve typically, over time, after a year or two, they typically do a big jump in the distribution. I wouldn't be surprised if they do that, but I do expect definitely a yield of over 10%. I think the yield is going to be phenomenal here. Because remember, these stocks are already big dividend paying stocks. So you already have like 4% yield on average, something like that, just with the dividends. Then you add the leverage, then you add the cover calls. For sure, it's going to be over 10% yield. I wouldn't be surprised if it's between 12 and 14%, close to UMAX. So that's it for UTES from Evolve ETFs. Pretty cool ETF. I like it. I like it a lot. This is Evolve's second leveraged covered call ETF. I wish they would have more leverage options. And the next brand new ETF, which I don't think is out yet, is from Hamilton ETFs. This is a fixed income, more conservative cash alternative ETF. I know many of you like that. It's the Hamilton U.S. T-bill yield maximizer ETF coming soon. So what's in here? It's basically 80% in short-term U.S. government bonds and 20% in TLT. So the average, if you take the average duration, is about 3 years. So remember, the smaller the duration, the lower the risk, right? So this is pretty much a very safe, stable, boring ETF that is really, like it says here, an alternative to cash, money market funds, T-bills. So this is really, in my opinion here, a pretty good place where you could park some cash. And you'll get a really nice yield, by the way. So their estimated first distribution, remember this is an estimate, is 10.5 cents, and the ETF is going to start at $16 unit NAV. So it's very easy to get an approximate initial yield. You just multiply by 12 for the annual, divided by 16 times 100. 16 is the initial start price. You're looking at an initial yield of about high sevens, guys, just under 8%. Pretty damn good, if you ask me, for a cash a cash savings or alternative cash savings ETF here. So this could be really interesting if you have cash, you like to park some cash, and hey, I'll make some, just under 8% yield while I wait. It's going to be low risk, but you are tied to what US T-bills do. But again, it's 80% short duration, which have a lot less volatility than long-term duration. So this is going to complement their existing U.S. government bond covered call ETF H-bond. The major difference, of course, is the duration. This one's going to has much higher duration risk. I think in terms of the duration, do they have it here? I believe they have it. Yeah, here it is. So the duration is about 17 years versus 3 years. So obviously H-bond, you're going to get more yield, but you're taking on a little bit more risk. That's for sure. Where it's H-bill, it's much less duration risk. So this new ETF really reminds me of SPay, so SPay is a good equivalent. I would say it's something that's very, very similar. So SPay, it's short term. It's actually basically the difference is it's 90% in the short term in the 0 to 3 month, and then 10% in TLT. HBIL pretty much 20% in TLT and 80%. So it's an 80-20 versus a 90-10. So a little bit longer duration than SPay. It also has a little bit higher yield than SPay. Same management fee though. So obviously HBIL, the thing that you could really compare to is SPay. This is also 35 basis point management fee. So I would put it in the category of short. So which is, right under MPay and HPYM, which is medium term. These are more about 6, 7, 8 years. So MPay, the duration you see here is just under 7 years. Same thing for HPYM. It's about 7 years, 7 to 10 here. So yeah, I mean, both SPay and HBIL, I think, if you're okay with investing in U.S. government bonds, mostly short with covered calls, this could be a good cash alternative for you. Much better than, of course, GICs. You guys know I hate those, or anything else. And if you don't mind, U.S. government bonds. So that is it for the two brand new ETFs. One of them, HBIL, is not out yet, but I'm sure it'll be out soon if the website is updated. And then you have UTES for Canadian utilities in Canada with 25% leverage. I hope Evolve comes out with more and more leverage products. They could even just, add leverage to their existing products. I think that would be fantastic. But there you go. If you have any questions, let me know in the comment section below. Of course, make sure you're subscribed to my channel. If you like these types of income-oriented funds, this is the bread and butter of my channel. Anything new that comes out, you are pretty much guaranteed that I will cover them. And see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the ultimate DIY investing package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and U.S. stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the elite membership. If you're interested in the elite membership, and even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.